What is up, everybody? This is Stock Market Education, and today we're going to be talking about McDonald's and whether or not it's a buy. Let's get into it. In 1955, McDonald's discovered the holy grail of producing high volumes of food at a low cost, which created an economic moat that became the catalyst to growth, increasing 160-fold from their IPO price of $1 in 1980. Many corporate executives of the company and hedge funds are buying McDonald's stock as of recently, and that's why we're going to take a closer look at McDonald's. Before we do, make sure to click the like button and subscribe to the channel because it really helps out for the YouTube algorithm. With that being said, let's go ahead and take a look at the numbers. When we look at McDonald's numbers, we can see that they're currently trading at $158.17. They have a PE ratio of 20.07, which is slightly higher than the S&P's PE ratio of 18.73. And over the past 2 years, McDonald's has smashed the S&P 500's returns, going up 39% compared to 6% in 3 quarters. They pay a dividend yield of 3.02%, which is getting to be maxed out by its payout ratio of 60%. So 60% is sustainable. However, there's not much more room for growth. Yahoo Finance assigned a future price target of $207.55, and TipRanks gave the company a price target of $211 over 12 months, which would be a percentage increase of 33%. Looking at their income statement, we can see that McDonald's total revenue decreased from $24 billion down to $21 billion for a percentage decrease of 12.5%. However, their management team strategically restructured their total costs, which resulted in a percentage decrease of 41%, which resulted in them increasing their net income by 30%. When we look at their 10K, we can see that they expect to open 1,400 new stores in 2020, as well as get an operating margin of 40%. Which is in line with their current profit margins of 41%. I love McDonald's company because it's a high volume, high margin business model. Looking back to November of 2019, McDonald's CEO Steve Eastbrook stepped down because he fell in love with one of his employees, and the president, Chris Kopensky, took his place. When we look at the price chart, we can see the stock was already on a retracement once this news broke, and the price actually continued to climb, which would suggest that investors were happy with the move to replace Eastbrook with Kopensky, most likely due to his responsibilities of overseeing 14,000 restaurants in the U.S., as well as his knowledge and growth initiates, which he was president for Kraft International. When we take a look at McDonald's improvement in management, as well as their 1,400 new stores opening, and their 41% operating margins, and their 30% increase in net income, and their projected $211 per share price target, it's safe to say that McDonald's could be an interesting stock to buy during the bear market. And you know, looking at this, the stock price wasn't hit too hard from the crash because most McDonald's are still fully functioning, or at the very least they still have drive-thrus that are open 24 hours. McDonald's is on my watch list. This was a stock I used to own but sold back in 2019 when Eastbrook decided to step down because, in my opinion, he was an amazing manager and CEO, and I wanted to secure my profits from McDonald's. However, McDonald's PE ratio will most likely not fall below the S&P's PE ratio because McDonald's is in a much more profitable position compared to most companies in the S&P. And they already reopened 95% of their restaurants in China, so McDonald's can see light at the end of the tunnel. But now is a time in the markets where you want to be careful because I guarantee you companies are going to go bankrupt over the next couple of months. So it's important to constantly keep up on the stocks that you own and making sure that they have plenty of cash on their balance sheets. Thank you guys for watching the video. Like and subscribe if you want to see more videos like this one, and have a good one. Bye.